Warren Buffett turned $10,000 into over $400 million. Joel Greenblatt averaged 40% a year. George Soros made $1 billion in a single day. Peter Lynch ran the best-performing fund ever. But here's the shocker. While these legends built fortunes, the average investor underperformed the S&P 500 by almost 3% a year. Why? Impulse. Fear. No process. So what do the world's best investors know? And how exactly did they beat the market for decades? This chart tells the story. The higher the point, the bigger the excess return over the S&P. The further right, the longer they kept winning. Most investors get lucky for a few years and then fade. But Buffett? He compounded at 20% annually since 1965, while the S&P managed about 10%. That gap, doubled every decade, explains why he sits at the top of the mountain. When we look at the world's best investors, we see more than just names. We see decades of discipline, process, and insight that allowed them to generate significant excess returns over long periods. They call him the Oracle of Omaha. Buffett's edge wasn't chasing trends. It was buying quality businesses at fair prices and letting compound interest quietly build empires. In 1988, he bought Coca-Cola for $1.3 billion. Today, it's worth over $25 billion, not even counting dividends. Over nearly 6 decades, his 20% annualized returns doubled what the market delivered. Buffett likes to remind us, the stock market is a device for transferring money from the impatient to the patient. Charlie Munger once said of him, "Warren has 3 things I never had: incredible patience, deep humility, and machine-like discipline." That patience, as steady as a redwood tree growing for generations, is what made him legendary, even though he admits he missed giants like Google and Amazon along the way. Joel Greenblatt may not be a household name, but his track record is jaw-dropping, averaging 40% a year from 1985 to 1995. His secret? A disciplined, rules-based strategy he called the magic formula. He didn't guess. He ranked stocks by return on capital and earnings yield, then invested systematically. No hype, no noise. As Greenblatt said, the secret to investing is to figure out the value of something and then pay a lot less. Michael Burry later called Greenblatt's framework a compass for finding order in chaos. His 40% annual returns were like climbing an escalator running twice as fast, relentless momentum that left others behind. George Soros didn't just invest. He reshaped markets. In 1992, he famously broke the Bank of England, making $1 billion in a single day by shorting the pound. Soros often said, "It's not whether you're right or wrong that matters, but how much money you make when you're right and how much you lose when you're wrong." Stan Druckenmiller, his protege, once admitted, "I've never met anyone with as much courage in investing. He'll double a bet when everyone else is panicking." That boldness could feel like the force of a tidal wave, though not every wave went his way. In the late 90s, he misjudged Russia and lost billions. Yet his ability to cut losses and keep moving defined his edge. Peter Lynch turned Fidelity's Magellan Fund into the best-performing mutual fund of all time, compounding at 29% annually from 1977 to 1990. Lynch's philosophy was simple yet powerful: invest in what you know. He scoured malls, restaurants, and daily life for overlooked companies. He liked to say, "The person that turns over the most rocks wins the game." Jack Bogle once said Lynch had an unmatched gift: connecting Wall Street to Main Street. Lynch admitted he was wrong 40% of the time. But like a treasure hunter digging through rocks, the gold he found far outweighed the misses. If you had to choose, would you bet on Buffett's patience, Soros's boldness, or Greenblatt's formula? Tell me in the comments. Every legend has roots, and for modern investing, the roots are Benjamin Graham and Walter Schloss. Graham, author of The Intelligent Investor, taught Buffett himself. His principle was the margin of safety, always buying far below intrinsic value. Schloss, one of his disciples, quietly ran his own fund for 47 years, compounding at 15.3% annually versus 10% for the S&P. Buffett once said admiringly, "Walter did it without the benefit of a business school education, and it worked." Schloss had flat years where nothing seemed to work, but his commitment to process kept him in the game. Shelby Davis turned $50,000 into $900 million by betting big on insurance stocks when few others cared. David Einhorn, founder of Greenblatt Capital, became known for bold contrarian shorts. In 2008, he exposed Lehman Brothers' weakness before its collapse. He once joked, "What do you call a stock that's down 90%? A stock that was down 80% and then got cut in half again." Bill Ackman remarked that Einhorn had the courage to say what everyone else was thinking, but afraid to say. Of course, Einhorn also had painful misses, like betting on Sun Edison, which went bankrupt. But contrarians know, you don't have to be right every time, only right big when it counts. Stanley Druckenmiller may be the most underrated investor alive. For 3 decades, he compounded at 30% annually without a single down year. He blended macro themes with sharp stock picking, moving with flexibility instead of locking into one style. Druckenmiller said, "The best investors are not afraid to change their minds." George Soros, his mentor, once praised him. "Stan's record is even better than mine. He's more disciplined." Not every move was perfect. He later admitted misjudging parts of the dot-com bubble, but his adaptability kept him undefeated. So what separates legends from the rest of us? Excess returns come from a defined edge: value, macro, or growth. Compounding requires patience and discipline. Process beats impulse. Every one of these investors trusted their method across decades. They weren't chasing trends. They built processes that lasted lifetimes. The world's best investors remind us, fortune isn't built in a day, but decade by decade. At ClearPath Gen, our mission is to pass these lessons on to the next generation, giving you the clarity, confidence, and tools to build wealth on your own path. Start early, think sharp, learn right. That's your clear path.